Well, traders are taking a look at the NASDAQ 100, and then I want to go over what's going on with the Fed's balance sheet. And finally, we're going to put on a trade based off of all of that. So the first thing that I've been looking at every time I look at a chart, I have the RSI pulled up. And this is something that I normally don't have. I may have something like a CCI or Bollinger Bands, some moving averages usually, but not an RSI. But for the last few weeks, as we've been going higher and higher, I've always kept the RSI in mind because we get overbought and then we pull back and then we have pretty nasty pullbacks after that level. And so if this thing gets up here, I think that could get lower. And so the downside is definitely there. And from a fundamental perspective, what everybody says is the Fed has your back. We're going to get to that later, which also has me worried about some downside. So overbought, so definitely it could go down if it gets overbought. Um, so not too much upside going into next week. With that said, though, the weekly chart looks very bullish. If we go on to the weekly, let's go on to right here. The weekly looks quite bullish. Trends look good over there. Usually, I like to look at moving averages and see whether it bounces off those moving averages or exponential moving averages. And the exponential moving averages usually sandwich right below the price. 8-day exponential moving average usually. That one looks good. Right here, I have the 250 and 200 pulled up. And the 200, it bounces off the 200 right here, right here, or this is actually the 20 right here, right here. I would not be surprised if we get another bounce. So it's still an uptrend. We can't fight the uptrend, but at the same time, it could get overbought and we could go down. Later on, I'll get into what's going on with the Fed's balance sheet, but it could go down because of that. High valuations, it could go down. So there is significant downside, but at the same time, it's still an uptrend, and we don't want to fight that uptrend. So you got to ask yourself what you're going to do with this sort of a market where you have an uptrend, but fundamentals don't look good, but you don't want to fight the price action. And that's what we're going to do a front spread trade going into this, later into this week right here. And let me clear all this off right here. So as I said, the moving averages tend to act, especially the exponential ones. I know right here I have the simple ones on. If you look at the exponential 8-day or 8-period moving average, it tends to sandwich the price and it tends to bounce off every single time. And that's a good indication of an uptrend. But of course, when you're doing trend following, you wait for a new trend to start. So if I'm trend following, I might just buy at the top, and then until the trend changes down, that's when I start shorting. And the thing is, when you trend follow, the number one problem is you're not going to be able to find the perfect bottom. You're not going to be able to find, if this is the top, the perfect top, because you're going to wait for the trend to change, and you're going to lose money throughout that if you're long. So it's definitely something to be looking out for right there. The fact that this trend could reverse and that it takes a while for the slope of these moving averages to start moving down. Another thing that makes me bullish right now is the positioning. So 1/5 of all investors have sold all their stocks. Now, if the market keeps on going higher, and the reason I chose the QQQ specifically is because it has a lot of relative strength over all the other indices. Just on Friday when we had that quad witching, the Qs stood up and they were positive on the day, or I guess minus 0.02, so just slightly negative, I guess, break even right there. But they're quite good when it comes to relative strength, and 1/5 of investors have sold all their stocks. Now, if the market goes higher, there might be some FOMO where a lot of these investors want to buy back in even though the price is further up because they're worried about it running away from them and it never coming back for them. So that's something to look out for right there. But that offers us, I've been talking about this before too, weeks ago when we were right here. I said it's likely to go higher, and it has. And the reason I said that is because many funds have just started to position themselves in. And many mutual funds, what they usually do is that they look for a cross of the 200-day moving average, and then finally they start selling about down here. Normally, it's going to work in a crash because in 2008 the price went like this, and then it started to go down, and then it really crashed. In this market environment, though, it didn't work that well because in this sort of a market environment, we had a situation where people are using these long-term moving averages and death crosses and such. The death cross didn't happen until the very market bottom. Right here, if you just use the 200-day moving average, you didn't get out until the bottom. And then you would have not gotten in until up here for the 200-day moving average. Or the 50 crossing the 200, you would have not gotten in until essentially, let's see, the 50 is right here, 200 right here, so basically right here. So you would have actually lost money by using a trend following indicator because it was such a V recovery. And so I think still that we have people waiting on the sidelines, since 1/5 of investors have sold all their stocks, that may buy back in, and that might be part of the positioning. But I'm still worried about that downside because valuations are high, although they have been high for quite a while. And when I say quite a while, I don't just mean a few months or a few years. Ever since the Fed started pumping this thing up in the late 90s with the tech bubble, valuations in tech have been soaring, and then later on real estate joined, and now you're in a situation where you have an everything bubble, for a lack of a better word. And so the high valuations have been going on for a long time. And so you can't just short based on high valuations because monetary policy also has to be taken into account. But that's where I come upon the Fed's balance sheet. So let's see, right here, Fed balance sheet. I think I accidentally clicked on that. But right here on the Fed's balance sheet, as I said, you can't just short on high valuation. We've had high valuation since the late 90s when the tech bubble started. And after that, the tech bubble was caused by cheap money. It was caused by loose monetary policy. Then after the tech bubble, Fed funds rates went to 1% in 2004. That caused a housing bubble. 2003, 2004 caused a housing bubble later on. And that popped, and then rates went to zero, in some places negative, and it created an even larger bubble. Now it's essentially just turned into a everything bubble, and especially all of the risk, all of the remember, you can't take away risk. Risk can just be transferred. It can never be taken away. So in 2008, the risk was transferred to the taxpayer. This time, the risk is going to be transferred to anybody who's holding dollars through inflation, through a hidden tax. But the risk cannot go away. The risk can only be transferred. And that's what they've done so far, and they push markets higher, and they've transferred the risk into currency markets. But valuations have been high for a long time, so you cannot just short based on valuations and fight the bullish price action. But at the same time, you can't just sit on your hands because you can't let the price action run up. And if you just went out in the year 1995 and you said it's going to start to turn to a bubble and valuations are starting to become high, I don't want to buy into the market. Well, you would have missed out on a large bull market and subsequent bull markets after that. So you can't just sit on your hands to not do anything and let the price run away from you. You definitely can't short it, even though there's a high valuation, because monetary policy has their side. And you have bad economies like Venezuela, where the stock market goes up 9,000% a year because of all that inflation. So you can't just short because of high valuations. And you can't just sit on your hands and not do anything, not participate when that market is going up. So I wanted to take a look at the Fed's balance sheet because, as I said, monetary policy, though, brought this up. If we look at the Fed's balance sheet, it really started increasing right here, August 2008, and then later on right here, 2009, and that's when the market started to recover, went higher and higher. Right here, QE3 went a lot higher, had this contraction in the balance sheet right here. Eventually this stopped, though. If we look, eventually this stopped because the Fed kept on raising rates, and if you guys remember, in late 2018, the market started to go down. And the Fed will do whatever it takes for the market to go up. And right now, or traditionally, usually I should say, not right now, traditionally the Federal Reserve really doesn't care about the equities markets, they care about what's going on in the credit markets. But the credit markets and the equities markets, they are connected together. Now, though, I do believe they care about the stock market because they're selling by junk bonds and corporate debt and such, and that has a direct correlation with stocks. But right here, we basically saw a bottom out, and then in September of 2019, that's when the real problem started. That is when we saw, and I think we talked about it on this channel actually, I had said quantitative easing is coming back, and this was actually the timing, I gotta say, the timing was luck, but I had come out in September 2019. This channel was just made, and I basically said we're returning to quantitative easing, and we did return to quantitative easing. And until we returned to quantitative easing, we went larger and larger and larger, and then we can look right here. Yeah, let's look 1 year back. And right here, the quantitative easing started to flatten out right here. So the Fed's balance sheet went higher, started to flatten out. And that's also when credit markets started to see problems. Once again, the repo markets in February. I can talk about that in a later video, but that's when problems started to happen. And that's also when the stock market started to crash. And on top of that, you had coronavirus. And now the Fed's balance sheet started to go up. Now, here's a big warning sign that we're starting to see. We can go out onto a 3-month balance sheet, and everything is starting to flatten out. Before, it was growing at over 300 billion a week, probably like 400 billion every single week. Now you look at it, and now it's actually starting to contract. It is actually starting to go into contraction. And this is a big warning sign because everybody's buying stocks. 1/5 of investors have already sold. And so there is an argument for positioning to the upside if they buy back in because they're worried about it running away from them. With that said, though, the other argument can also be made that you don't fight the Fed, so you buy stocks. But the Fed isn't doing anything. The Fed is, in fact, contracting the balance sheet. The balance sheet is going lower. They're contracting the balance sheet. And so if they're contracting the balance sheet and the balance sheet is going lower, then the don't fight the Fed argument doesn't work, and you have high valuations. So fundamentals to the downside look it looks quite bearish to the downside because bad valuations bring it down, and then bad Fed fundamentals bring it down because the Fed isn't pushing this thing up. The Fed's balance sheet is now in contraction. So you can't say don't fight the Fed anymore because where is the Fed? The Fed is not taking, it's all bark and no bite. They're not taking any action. So the downside is still there. To the upside though, you got positioning, and then you also have bullish price action. So here's a trade though. If you have proper trade structure, you can take a situation like this on. I want to put a front spread on where if the price goes, let's clear this thing right here, remove drawings. So if the price goes up just a little bit, we make money. If the price goes up a lot, then we lose money. And the price goes down, we are at break even. So I'll still put a check mark though for break even. It's basically a costless trade. So we're not getting a credit, but at the same time we're not having to pay a debit. It's a costless trade. But if it goes down, then we still end up break even. So it can go to lower lows over the next week, and we would be at break even. It can go to higher highs, and we would be good. But if it went too high though, that's when we'd probably have to start making some adjustments to this trade. But that's what I want to put on, and the sweet spot for this trade would be up at around this level. That is our target going into next week for the NASDAQ. But if it doesn't reach that target and it just goes to lower lows, that's fine too, because that trade is down at a break even. And if it goes a bit higher, our break even to the upside is at around, so 244, 250, so it should be around right here. So there we go right there. This is our break even to the upside, and this is our profit target right here, max profit for this trade. So for this sort of a trade right here, just looking for relative strength in the NASDAQ and also looking for some upside with the bullish price action continuation. Simultaneously though, we cover our downside. What's the trade? Well, I want to short 250, so short 250 calls expiring June 26, 2020. And then I want to go long a 247 call expiring June 26, 2020. So it's expiring this Friday. And this means that we would get long right here. And then we would have to get short 2 of them right here. So essentially what we're doing is -2 +1. So +1 call right there, and then -2 right there. This means that we're looking for a little bit of upside, as I've already said. You can pause the video right here and take a look at that trade structure, but I think it's a good ratio spread going into next week. And right here, if it goes too far up, we can make a trade adjustment and roll that debit spread higher. But other than that, I think that's a good trade structure going into next week. And I'm just looking for some relative strength on the NASDAQ right there. Also, even though this trade is not positive theta, what we're essentially doing is that we're shorting some calls all the way up here and we're buying some calls all the way down here. This creates a situation then where you have something that we call a theta variance trade. What is a theta variance trade? So theta variance means that a normal at-the-money option decays like this. Maybe I can redraw that a bit better. It's going to decay like this. It's going to decay in an exponential manner, and as it gets closer and closer to expiration, it decays more and more and more. And the out-of-the-money option, though, it's going to do something similar, but it's going to decay in a manner like this, where a majority of the decay occurs out here. A far out of the money option, 2 standard deviation, is going to have a majority of its time decay out here. And so what we can do is we call this a theta variance trade. We're selling these options right here, and then we're buying these options right here. So even though from a at expiration perspective, time decay is not going to be different, it is a theta neutral trade, we're putting ourselves in a position where the calls that we have sold are so far out of the money that they start eroding very quickly, and theta decay starts on them very quickly, and within 2 days they're basically worthless, while the calls that we're buying, they tend to lose most of their value usually 2 days before expiration, while the ones that we're selling tend to lose their value 4 or 5 days before expiration. So it's a theta variance trade where the out of the money options that we sold, the far out of the monies, they tend to lose their value very, very quickly, and the slightly out of the money option that we bought, that tends to not lose value as quickly, and so we're able to get out of the trade, even if the price stays the same for the next 2 days, get out of this front spread, and then roll it into next week as an alternate if the price stays the same, and take advantage of that theta variance where the far out of the monies decay very, very quickly, the 2 standard deviations decay very, very quickly, the 1 standard deviations decay very, very quickly within a day or two, and the at the monies, or the slightly out of the monies, like half a standard deviation, don't decay until a day or two before expiration. And so just take advantage of that with a theta variance trade, as we like to call it. Other than that, if you guys have any questions, just go ahead and ask us down below in the comment section. If you guys are on StockTwist or on TradingView, go ahead and ask us right there too. Thanks for watching, everybody. Stay profitable and happy trading.